And when inflation goes up, you don't like that if you're a consumer of those products, but you like it.
I believe in the snowball effect. Get out of that bad debt. Like, it doesn't make sense to pay you guys money for a stock to get 8 or 9% if they're paying as a mortgage lender. I see it all the time. People call me, we're getting a divorce. How do we deal with our mortgage? Hey, this is the Money Hole Podcast. This is going to be episode 2 with my friends Anne-Marie and Courtney. Super excited. If you didn't check out the first episode, make sure you do. And as always, I know a lot of you are watching this, listening to. Please make sure to like, subscribe, download, or leave us a 5-star review so we can get this message out more. Thanks for coming back. So our first episode, we talked about a lot of things, but it's 2024. It's a very interesting time. We've never seen inflation like we've seen. Well, maybe we have been 40 years ago, but most of us have not seen a time like this where everything costs more. We've got high interest rates, so borrowing costs are high, and wages have not kept up with how much people have to spend. In fact, I was talking to someone earlier, like, we're having a lot of people call our mortgage office right now, the children of seniors, saying, can our parents get a reverse mortgage? Because they paid their house off, they have a little bit of money saved, and they have a pension, and they thought they did everything right.
That's right.
Now, they can't come and talk to you guys. They don't have anything to invest. So the only asset they have is their house, and, or their kids are going to have to help them. So their kids are like, well, it's either going to come from us or it's going to come from you. Why don't we see if this is an option? And so I got a lot of questions that I've had that I wanted to ask you guys, being, financial advisors. I know you guys work with people from the beginning of this journey of trying to build wealth. And I also know you guys have clients all over the country who have millions and millions of dollars. So I thought it'd be cool just to get some tactics, some really practical things that people can think about and do even in a time like this, because, there are people making money right now, and there are people raising their income and making moves in the stock market and actually getting a pretty good return this year. So I want to talk a little bit about inflation, number one. So one of the things that I hear often is people come in to get a mortgage and they say, well, I have a bunch of cash. And when I hear cash, I think, oh, you've got a money market account. Great. Yeah. And they're like, no. I mean, I got 100 grand in my safe.
In a safe.
And so a question I get a lot from people is, I understand why they do that, but they don't understand that doesn't make your money safe. It actually doesn't help at all. But I think what's behind that is people are seeing what's going on with inflation. How can people protect their savings right now from inflation? What are some simple ways people can do that? We'll start with you, Anne-Marie.
Yeah, I mean, we always go with the rule of thumb of trying to understand what someone's 3 to 6 months worth of expenses are. And that just needs to be in a very safe place, maybe not as safe, but in the bank. And then above and beyond that, there's ways that you can work with the market and, be in simple investments that can keep pace with inflation. They're usually things that people have to have. They're in the budget no matter what. They're your needs versus your wants. And when inflation goes up, you don't like that if you're a consumer of those products, but you like it very much if you're an investor in those products. So those are the tried and true, just kind of dividend paying companies. And then the higher interest rates have given more opportunity for people to earn more on their cash, so to speak. CDs are paying more, money market rates are paying more, they're more competitive. So leaving it in the safe, there is some missed opportunity there.
Lots of missed opportunity. Yeah, I think that when it comes to cash management, even whether it's a business or a family, I think people sometimes aren't prioritizing liquidity.
Yeah.
And so that's where the cash management comes in. Mm-hmm. There's CD laddering right now. And that's also how you would get away and mitigate the risk of rates falling, is lock it in for a good year, right? And then you can pick it back up with that portion of your money that's supposed to be not really growing much, but you're getting some income on it. Laddering CDs, I mean, 2-year bonds are paying nicely right now.
And these are investments that have a little bit of upside, enough to keep up with inflation, but very little downside, right?
I mean, it's really for income.
Right.
They're not even really keeping up with inflation. It's just, that's not true. It's better than putting the money in the safe. So if you're comparing those two things,
or even just a regular bank account.
That's right.
Right. But if you're
non-interest bearing.
Exactly. Yeah. But a liquid money market, you could put, if you think you need money in 6 months, put your money in a liquid money market, get your 4.5%, 5%, depending on where you're at, 5.5%, and you'll be able to pull that money out. There's no maturity around it like you would have with a CD or a treasury bill. So what kind of liquidity do you need? And that will drive the cash management strategy that you use.
That's really good. So we follow a process in our coaching group. And, everyone talks about Dave Ramsey. Like, Dave Ramsey didn't invent a lot of his concept, his sound financial principles, right?
Yes.
So I agree with a lot of that for that reason. I don't agree with some of his mortgage stuff, and we can get into that. But the idea of getting out of bad debt, like, we bought a car this year and my CPA is like, yeah, pay cash for it. I was like, okay, that's a lot of money. Because, last few years when rates were 0%, he was like, yeah, get a loan on that. Put 20%, put 20,000 down and then pay it off in a year. Your money's making this over here, that over there. But now it's like, if something's 8 or 9 or 10%, don't get it. Like, that is just crushing people. I mean, I think credit card debt right now, last time I looked at $17 trillion, the highest it's ever been.
Crazy.
And I have so many clients and friends that they're ashamed. They shouldn't be, because I always try to make my friends feel safe. Like, I've been there. That's my role. Let me help you. But they'll tell me like, hey man, I got 8,000, 10,000, 20,000 credit card debt. And this minimum payment is crushing me. It's 29%.
Wow.
So like, the first thing we try to help people with, and I want to know if you guys would agree with this or you have different ideas, is I always say build up the 3 to 6 month survival number first while you're paying your minimum payments, because you can bankrupt or walk away from credit card companies if you got to buy food for your family. So secure yourself first. And then, I believe in the snowball effect. Get out of that bad debt. Like, it doesn't make sense to pay you guys money for a stock to get 8 or 9% if they're paying 18 to 20% on these credit cards.
That's right.
Correct.
Like, let's get out of these credit card debts.
Got to get out from underneath it.
And keep that 3 to 6 months in case something happens. One of you loses your job. You guys aren't panicking.
Right.
And then from there, what would you guys say? So let's say someone goes through that. They pay off bad debt. They've got 6 months of reserves. They've worked really hard to get there. They now all of a sudden have $3,000, $4,000, $5,000 a month of disposable income, and they're convinced they're going to keep their lifestyle the way it is because they want to think about the future. Like, where would someone go from there?
Well, the discipline of getting out of the debt is going to be the same, just structured discipline they're going to use to start to build wealth. Now they're not paying out of pocket for that, and it's not working against them. And so they can start making it work for them. And so, like you said, that 3 to 6 months worth of the living expenses, that's kind of step number one. But most people have a vehicle right there at their job, which is a 401k that they would start saving into. Most times with a 401k, you have a match. That means that the company is matching up to a certain point of the money you're putting in. So in a way, it's like a raise. It's free money. We always say, don't leave that on the table. And then see where they can go. It's kind of just filling the buckets. Once they've exhausted that and they've put in as much as they can per year, because there are limits, perhaps they start a regular interest-bearing account in the name of, say them and their spouse, and, maybe earmark it to start a fund to purchase more real estate besides just the home they live in. So they can really start that's a lot of flexibility every month once they get out from underneath that.
And with that strategy, they're actually deploying a concept that's so important. It's dollar cost averaging. And they don't even know they're doing it, but they need to know they're doing it. Dollar cost averaging, when you're adding money into an investment, whether it's a 401k or just a regular investment in your name, you're doing it on a regular basis. And there's a certain amount going in. Let's say you're adding it into the stock market. You're buying in when that share price is either lower or higher on any given day. It changes, right? It moves throughout the day. So when you're doing this on a regular basis, over time, what happens is compounding, the magic of compounding, because you end up paying less per share. And that's how your money grows. And that is a beautiful thing. And that is heavy lifting. But people feel like they're not doing anything because, they're not doing it themselves. And it's like, find a high quality investment, deploy the dollar cost averaging concept, and that's your behavior. That's it.
Yeah, no, that's really good. I showed my team one time because I don't know where I saw this, but I said, everyone says, well, what if I buy and my money goes down? And you guys would probably tell people, well, that'd be the best thing that would happen.
It's on sale.
No, that's right.
Because then we could put more in, right? But I show them this, I read it on a whiteboard, like if you start dollar cost averaging right here, and let's say it's a top, and you literally pick the worst timing in the world, but you stay faithful to it because Courtney and Anne-Marie told you it was the best idea, and you did it every month, and it goes down for 2 years. We're in the worst cycle ever. And then it flattens out for a year, and then it slowly starts climbing back up. And it's not till 5 years later that you're back to where you started when you started the 5-year journey. But you did it every month, no matter what. Guess what your return on investment is from here to here? You guys know what it is? You ever seen that before?
I haven't seen that.
200% return on investment.
Oh, wow.
Yeah.
Nice.
Yeah. So you guys should show that to people.
We absolutely should.
Pretty good little.
Yeah.
I used
it's a good trick.
We like pictures. We like pictures too.
Oh,
yeah,
we
love
like
them.
a good picture.
Yeah.
I try to keep it simple. I think one of the worst things about financial planners for the common people is they make it too complicated.
Oh, yeah.
100%.
Same with mortgage people.
We talked about that so before we changed firms, we went through a really intentional, focused core values process. And that was one of the things that came up was we are so committed to keeping it simple because it doesn't, all of the charts and the graphs, if someone's just nodding, but they are basically just completely confused, then we didn't do our job and they're going to leave and they're not going to want to admit it. There's going to be shame around it for whatever that's not a good reason. But, we want to keep it simple so that they completely understand, or at least understand more than they did when they walked in the door. And then that can be a process over time. It is not our job to get fancy and make them feel foolish about it.
Yeah, getting away from that industry jargon.
Yeah.
But what makes us really happy, and this is how we operate, is usually in a family, there's a point person who likes dealing with the investments. So we're talking with them mostly.
Yeah.
But when the spouse or the partner or whoever, the kid comes in and it's not something they're that interested in, but they know it's important to be there, and they're actually just getting these nuggets, it is the most beautiful thing. And they love it. They walk away and they're like, I really learned something today. Did they learn something different than what the point person learned? Yeah, that's how it would be with anybody. You got to start somewhere. And then you start liking it, actually. It's like anything. Once you start knowing a little bit more about it, you get better at it, you end up liking it.
Once you become interested and you start getting educated, and you realize like this is something that can really help you. Just like nutrition or food or anything else. I mean, not everyone, got to a point where they were super fit. Like they had to learn stuff. And then you start becoming addicted to it and you start realizing, oh my gosh, sugar is so bad for me. No one ever told me that. And so I agree 100%. So Courtney, I got a question for you. So you're involved, one of your certifications is helping businesses.
Yeah.
And I told you on the phone earlier that a lot of the people that listen are probably not at the point where they're going to sell their business yet.
Yeah.
There's probably a few. But one of the common things that I hear from people right now in this current economy is I don't make enough money to buy a house and I don't make enough money to invest with you guys. What are some of the things that you have seen and would just advise people that have that mindset on like because from my perspective, it's never been easier to make more money with the internet and with things like a podcast and content. I see it every day. Like that's not my theory. I've seen so many people. I got a guy in my office who moved here from Switzerland. He's going to make 6 figures this year and started his company when he didn't even have a green card. And I could tell you a dozen stories like that. So when it comes to people that want to start a business, what are some of the things that you would tell them to advise them on that journey? Because I think that's one way that people can get out of the 9 to 5 right now and really accomplish things financially to where they could come to someone like you guys and invest their money.
Absolutely. And having that hope and knowing that they're going to find something. If they keep going with that activity, they'll find something and they'll enjoy it. But we take the approach of Cody Sanchez. I mean, there's a lot of So
she's pretty cool.
She's amazing. Find her on Instagram.
Okay.
She's PhD. She was on Wall Street. She branched off. She's in her 30s. Yeah. I love her Instagram page because it's all things healthy. I mean, she's fit. She knows how to buy businesses. She's about just being, she's Latino. So she loves, just America and just all things that make this country go.
Cool.
And very entrepreneurial, but she is all about buying boring businesses. Mm-hmm. It's the anti-startup idea. It's not about venture capital. It's find a boring business, a car wash, a laundromat, a plumbing company with a plumber that's trying to retire, right? You go in and they're undervalued because these guys, you add technology in, you start looking at the insides, this skeleton of the company, you can do some great things with it. And then you just have to get creative with how you structure buying that. If you have no capital, you don't have to get a traditional, structure something with the owner and say, hey, I'll pay you such and such of revenues over, 2 years, 3 years. And you don't even have to have that upfront capital. And you build that thing up, run projections, and lo and behold, now you have a company, you run it for 5 years. Maybe you go, horizontal with it and start being a supplier to the detergent or whatever it is, and you start building from there. So those, I think, are massive opportunities, especially in our country. If you wanted to go be a business owner, that's a great way to do it.
Yeah. No, that is, because one of the trades that we need the most right now are the trades.
Yeah.
Like I don't know if you guys have seen that, but there are so many people who have gone toward finance and tech in the last 20 years that all those guys, the plumbers and the sheetrock guys that are retiring out, like there's such a lack of people coming in for those roles.
That's it.
No one took their place.
And if someone has excellence, and like you said, technology, I always tell people like, hey, during recessions, people still spend money. They just are more selective.
Yep.
Yeah.
And so you can kill it during a recession. You just have to be better than everybody else.
Yep.
You don't have to be cheapest.
Yep.
You just have to have the value. So that is really cool. And what was her name again?
Cody Sanchez.
That's really cool.
Yeah.
Well, I have a question for both of you, actually. I'd love to hear both of your thoughts on this. So I wish it wasn't the case, but right now in America, like the divorce rate is above 50%. I don't know exactly where it's at. But as a mortgage lender, I see it all the time. People call me, we're getting a divorce. How do we deal with our mortgage? And, the sad thing is a lot of times by the time they call me, they've already been separated for a year. Sometimes someone hasn't been paying the bills. Credit scores have dropped. It's very emotional. It's very heated. And they both end up really kind of suffering financially as a result of not calling me earlier, And I know you guys deal with that too, with people that have investments. And so tell me just a little bit, we'll start with you, Emery. If someone were to be going through a divorce and they have some assets, like what are some of the things that you're doing on that first conversation to help them avoid making horrible decisions that's going to ultimately affect their kids?
Yeah. And that's the hardest thing, because I think I mentioned on the podcast that I was on with you before that it is such an emotional time, but decisions have to be made, because usually one or maybe both of the spouses, they don't want to be married anymore. They're going through a divorce because they want to, have an end in sight with the separation and division of things. So a lot of times they will go to an attorney, which is great. Attorneys generally have knowledge, but not maybe as complete knowledge as a certified divorce financial analyst would. So seeing a CDFA, which is what the term stands for, really makes sense, because they are not emotional. We are not going to be emotional, and we can help them with coming up with a plan. They can take it back to their spouse or soon to be ex, and they can take it back to the other attorney and then start the negotiation process, but just not going at it alone. If you're in a situation like that, a lot of times people say, we're amicable. We have all these assets, but we're going to just get a paralegal, or
I hear that all the time.
And
it never turns out good.
And that's kind of just part of the process, because they initially
I heard
think
that
that's
today.
the way to go. Yeah.
I heard that at 12 o'clock today, those exact words.
And it usually, unfortunately, I've just seen it enough times, it tends to not go as well as they wish. And then they have to backtrack, get the attorney, maybe see a CDFA. But you have to have the professionals, because you are maybe not in your best frame of mind, but the decisions will have lasting repercussions.
What are your thoughts on that? I know you've dealt with that a lot as well.
Yeah.
Yeah, I mean, there's a lot to be said for doing something right the first time. We have actually seen when we have helped, it's mostly women that come to us.
Yeah.
And they end up with, obviously things are split 50-50. It's usually complicated. And the first year, they make some real silly decisions. We keep talking about that. It's like, what is going on this first year? It's like they get this pot of money and all of a sudden they're wanting to, I'm going to go buy this business. I'm going to go move here. I'm going to go do that. And it's like,
buy a restaurant.
Slow down.
Yeah.
Oh, that
bar.
Yeah. Slow down. Take a minute.
Take a breath.
Take a minute. Let's let the dust settle. So there's this transition time.
Because your decision making after something like that, it's not great.
No.
I mean, whether, we wouldn't know that if we're in that place, but, you just came out of, you guys have seen it, and we're at that age where it's happening. People are getting divorced and they're just not on their A game.
No. And you can't be, and that's such an important, it's, when we help them, a lot of times it is just, let's just pause. Okay, everything has been divided. That doesn't mean that we need to make any decisions with the amount that you have received. We can wait, and that probably is what's best.
The ones we've seen who've done it the best are the ones who understand that they are in an unusual mind space and heart space still, even though they're relieved from the divorce being completed, and they create a dream team around them to stop them from themselves.
Yep.
So they have their tax person, they have their estate planning attorney. They don't make any hasty decisions on their beneficiary designations, right? Because we're talking this through with them. The estate planning attorney is talking this through with them. They have us, and they use us as counsel, which that's a model for really any big decision in life, right? You have your people around you that you know and trust and listen to and want to help guide you.
A wise man has many counselors.
Yes. So that's when we've seen it work really well.
Yeah.
And what I would add, when they get personal counseling, that's a big part of it, because it's easy to say, oh, my ex is terrible and this and that. It takes two. There's always
you're at least
ownership.
50% of the problem.
That's 100% right. And so diving into that, having the courage to do that can help a great deal.
Yeah. I was telling my friend today who's going through this, I was like, because he's in a new relationship now, and it's been a while. And I was like, hey man, the things that she told you, like, don't forget those things, because like it isn't gonna be long from now and you're gonna realize, oh, this is familiar. Like you get to choose to like show up differently.
Right.
That's right.
Because I don't think it's gonna be that different. Like I know it seems really good right now, but
yeah.
I have a feeling like the issues you encountered are gonna come up up again.
He hasn't done the work yet.
He's done some of it.
Yeah.
I think there's more, and I think he agrees with me. He's a good friend of mine. So well, last question for you guys. So for the people that are young, or the people that are not even close to being able to do anything that we've talked about. And maybe they have fear or insecurities or shame, and maybe they never had people around them that had money. I know that, like, I came from a lower middle class family. No one had money in my life. And, you've heard my story, Emery. I'm definitely like the last person that should be where I'm at. Your story, I don't know your story yet, Courtney, but your story you shared on our podcast, like you really had to fight for it. What are some of the things, and I know you guys have a lot to say here because of what you guys do outside of work, that people can do to begin to develop the right mindset and just some initial steps to aim towards someone that could come to you and say, I'd like to invest some money, because they're doing well and they've got a business now and they're making extra money and they don't have bad debt. For someone that isn't there yet, what are some of the things they could do?
Yeah, there's so many great resources that are at our disposal. There's incredible books out there, and it doesn't have to be that you're picking up a book about money and how to invest. It's just the discipline of living a life with a growth mindset, doing things like getting your mind right in the morning, staying off of social media if prayer is your thing, doing that, being physically fit, developing these habits of discipline that eventually lead to freedom, including investing. Even if you are only able to put away $25 a month, if you are starting young, that can add up quickly over time. And like Courtney was referencing earlier, the beauty of the compounding. So I think it's those small habits and getting yourself in that mindset, and then being able to see yourself potentially as someone someday, that visualization can't be discredited either. So I would say all of those things.
That's so good. I agree.
Really
and having hope.
Yeah.
If you're an investor, you have hope in the future.
Yep.
Yeah,
that is so huge right now. It's so huge.
So
and there's a bright future ahead for everyone, humans, individuals. Yeah. I would say 2 concrete tools that I think would be so great. And I wish my 16-year-old son would be hearing this right now. But the Acorn app is that's really great place. Yeah, that's the micro investing. It just rounds up when you have a debit card, run it at the store, make a $5.70 purchase, 30 cents is going into an investment. Great way to start. And then the second is there is a book. It's called The Psychology of Money, Morgan Housel. It is one of the best money books I've ever read. It's easy to swallow. For any age, I would say, teenage, maybe 18 and up. But even people who are seasoned investors would get a lot out of it because it dives into the actual psychology behind money. And there's so much that we bring into it.
So much
upbringing, our parents, the way they, felt around money. Then you're bringing that into a marriage sometimes. So it's a really important book. So those 2 things could be a good start for someone.
Yeah. Well, I'll wrap it up with a story that really ties in. I heard on a podcast, I don't know when it was, a couple years ago, there was this guy who was really wealthy on the call, and he was getting interviewed. And this guy said, "Hey, let's just say that we take all your money away from you and we drop you in some random city.
Yep.
How quickly do you think you would become successful again?" And I don't remember exactly how he answered it, but he said, "Well, my success is not based on the money that I have. And so I would already be successful." And he said, the money is just a measurement to value that I've been able to figure out. And he went on to say that he'd probably create it pretty quick because of what he learned. But the point that he said is, and I think to both of your points, was you can be successful without being an investor and figure out how to do that wherever you're at.
Yeah.
And then your chances of learning to be successful with money are much higher.
Yeah. And it's going back to those boring concepts. I mean, it's like if you can get your mind right in the morning and then you win the day, and then that builds into the week, and then it builds into the month and the year. And next thing you know, you are a success. So I think that I'm a big fan of the boring things, but they get you, and they are not the get rich quick things. Yep. We would both say that, that is not the way that our clients have built wealth.
And it's not money for the sake of money at all. It's about meaning. And that's that story you just said. The guy was finding meaning in existing there, and maybe he was just looked at the opportunities around him and excited about that and inspired, whatever it is. And whatever it is you're doing, find meaning behind it.
Yeah. Well, ladies, thank you so much.
Thank you.
Appreciate you guys being here.
Chris. Thanks.
Please make sure to like, subscribe, comment, or ask a question. We will get to all of them. And thank you so much for checking out this episode.